Hello guys, welcome to our presentation. We're at Team 3 and we're talking about current fiscal policies and concerns about inflation. At first, a table of contents. First, we'll talk about some concepts of inflation. Secondly, about the expansionary fiscal policy of the US during COVID-19. Thirdly, about the viewpoint of the FED, and lastly, about the viewpoint of investors. First, about inflation. Inflation is the decline of purchasing power of a given currency over time, which also can be seen as a quantitative estimate of the rate at which the decline in purchasing power occurs. And this can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. Secondly, dealing with inflation. To combat inflation and as thus the decline of purchasing power of a given currency over time, a country's appropriate monetary authority, like the central bank, an example, the Bank of Korea over here, or the European Central Bank in Europe, take the necessary measures to manage the supply of money and credit to keep inflation within the permissible limits and keep the economy running smoothly. This is called monetarism, which is a popular theory that explains the relation between inflation and money supply of an economy. For example, if there's a rapid increase in the money supply, the value of money becomes lower as the prices from products rise. Inflation is measured in a variety of ways depending upon the types of goods and services considered, and is the opposite of deflation. As just explains, a large increase of the money supply, an example, printing more money and distributing it among the people, or by loaning new money into existence as reserve account credits through the banking system by purchasing government bonds from banks on the secondary market, causes inflation. However, there are three different types of inflation where we can talk about. Firstly, the demand pool effect. Demand pool inflation occurs when an increase in the supply of money and credit stimulates overall demand for goods and services in an economy to increase more rapidly than the economy's production capacity. This increases demand and leads to price rises. As seen on the slide, if everyone suddenly wants to buy a new pair of sneakers, but the supply can't keep up, the price will shoot up, so that demand and supply will meet somewhere else. Secondly, the cost push effect. Cost push inflation is a result of the increase in prices working through the production process inputs. When additions to the supply of money and credit are channeled into commodity or other asset markets, and especially when this is accompanied by a negative economic shock to the supply of key commodity, costs for all kinds of intermediate goods rise. These developments lead to a higher cost for the finished products or service and work their way into rising consumer prices. For instance, when there's an expansion of the money supply, and this creates a speculative boom in the price of helium, products which are complemented with helium will rise as well. Hence why the price of balloons will rise as well when the price of helium rises. This is reflected in various measures of inflation. And lastly, we have the built-in inflation. This is related to the adaptive expectations. The idea that people expect current inflation rates to continue in the future. For example, the inflation rate that happened in 2021 will continue in 2022. As the price of goods and services rises, workers and others come to expect that they will continue to rise in the future at a similar way. And they will demand either more costs or more wages to maintain their standard of living. The increased wages result in higher costs of goods and services. And this wage price spiral continues as one factor induces the other, and vice versa.
Next, let's look at expansionary fiscal policy of US during COVID-19. First, the expansionary policy means a form of macroeconomic policy that seeks to encourage economic growth. The goal of this policy is to boost aggregate demand to make up for shortfalls in private demand. And this policy can be erected as two ways, the monetary one and the fiscal one. Here I will focus on the fiscal one. So from the fiscal policy perspective, the government enacts expansionary policies through budgeting tools that provide people with more money. For example, it includes tax cuts, transfer payments, rebates, and increased government spending on projects such as infrastructure improvements. Then let's look at how COVID-19 makes US to erect expansionary fiscal policies. Due to COVID-19, businesses and industries had some temporary closures and the personal income has decreased. Therefore, US goal of these policies was keeping people whole and make sure they would be able to pay their bills as the country was trying to get the pandemic under control. So there are these specific fiscal policies US erected last year. They did the supplemental in unemployment insurance benefits. Secondly, they did a pandemic unemployment assistance for workers who would not be eligible for unemployment insurance under normal programs, such as independent contractors, self-employed workers, and gig economy workers. Thirdly, they did a paycheck protection program, which means the forgivable loans to small businesses. By these policies, the Congress borrowed more than $3 trillion. This amount is about 14.5% of US GDP in the fourth quarter of 2019. This fiscal package amount at this current crisis has been substantial and much larger than the fiscal package enacted in 2019. And this fiscal response was successful is that personal income increased in the second quarter of 2020, which is the opposite of what normally occurs during a recession. Even though the US economy experienced its biggest contraction on record, with real GDP declining by 31.4% at an annual rate, personal income rose during this period because the government borrowed money and gave it to businesses and households that were disrupted. Also, the companies were able to reestablish their businesses, and the unemployment rate was on the declining way, which also represents successful outcome of the policies.
Hi, I'm Park Jong-ho, and I'm going to talk about the viewpoint of Fed about the recent situation. As we mentioned, Fed has been doing lots of quantitative easing, and vast amount of liquidity, which is money, has been released to the market. Therefore, the value of money would be depreciated. This is the graph, which shows the change of US 10-year Treasury note rate during recent 6 months. In here, you can see the Treasury rate has been increasing from less than 1% to 1.72% now. According to the Fisher effect, interest rate change is approximately equal to the change of the expected inflation rate. So we can see the expected inflation is increasing now. However, as you can see in this graph, the number of people infected by COVID has been decreasing now, and we have to prepare after COVID world since excessively suppressed demand will be exploded. And this will cause more inflation and bubble to its economy as well. But the more the bubble is, more the shock to the economy after the bubble disappears. So Fed needs to suppress the inflation to avoid the crisis due to the huge inflation. Then, should Fed start to decrease the inflation now? It is obvious for Fed that it needs to retrieve the liquidity and decrease the quantitative easing someday, which is called as tapering. But we have to think about the side effect of the tapering. To decrease the liquidity, Fed should increase the interest rate to make people put money into the bank. But it has the risk of taper tantrum, 긴축발작 in Korean, which means the shock of the financial market of other countries caused by the financial retrenchment policy of US. It will cause capital outflow from other countries to US since the interest rate of US is high and depreciate the currency rate of those countries. Plus, sudden decrease of the inflation will increase the unemployment rate according to the Phillips curve. And the unemployment rate is more critical issue in US than inflation nowadays. As you can see in this unemployment graph, it's more than 10% recently. So hasty attempt to decrease the inflation may disrupt the rehabilitation of US economy from COVID and deteriorate the employment problem. In conclusion, according to the FOMC, Federal Open Market Committee, Fed decided to freeze the interest rate to 0.25%, like this graph, which shows that Fed is not going to attempt to suppress the inflation for several years. Fed said current situation is not actually the inflation, but just a natural phenomenon, since the market was repressed abnormally by COVID until now. Fed mentioned that they are going to concentrate on the economic recovery and not withdraw the liquidity for now.
Hello, I'm the last presenter, Do-kyung Kim. It is true that Wall Street is concerned about US inflation. According to a recent survey of portfolio manager by Bank of America, inflation topped the list, beating COVID-19 as the biggest risk factor for the US economy, followed by taper tantrum. Why are investors concerned about inflation? The reason is that as vaccinations progress faster than expected in the US, the recovery is likely to show a sharp V shape, which could overheat the economy. The break-even inflation rate represents a measure of expected inflation derived from 10-year Treasury constant maturity securities and 10-year Treasury inflation indexed constant maturity securities. The latest value implies what market participants expect inflation to be in the next 10 years on average. Although the Fed reaffirmed its policy to maintain low interest rates for a long time, anxiety in the bond market continues. Contrary to the Fed's pledge, there are widespread concerns that prices will continue to rise. Wall Street sees 2% on the 10-year Treasury as a major inflection point. In other words, if the interest rate exceeds 2%, it is expected that there will be a substitution effect that increases the possibility that major institutional investors will sell their shares and transfer to bonds. In the case, the stock price adjustment is expected to be inevitable. The decisive reason why low prices have been maintained despite quantitative easing since 2008 financial crisis is that most of the released currency remained in banks. However, the COVID-19 situation is not a crisis for banks, so there is relatively much liquidity in the real economy, and there is a large amount of direct support, so inflationary pressure will be high. Despite the quantitative easing since the 2008 financial crisis, trend changes have not been observed in M2, a liquidity indicator released on the market, while the trend has drastically increased since last year. Investors continue to question how much the Fed will be able to absorb liquidity in a timely manner without hurting financial markets and the real economy, and these concerns are quite reasonable. This is the end of our presentation, and thank you for listening. We look forward to various opinions through iCampus.